Hello.
Hi, Arshil.
Yeah, hi, Sasha.
My background is fine. No, it's not flipping.
No, it's fine. Yes. Did you get an option also saying that custom live streaming is going to be happening?
Yes, yes.
Okay, you got that one too. Okay, sure.
Harshil, you'll have to enable screen sharing. It's saying host disabled participant screen sharing. I'm not able to share my screen. Hello?
Can you share the screen now?
Let me see.
बस actually मेरे को दो बार सुनाई दे रहा है. I can mute the live stream too.
1 second, I'll have to just see something. How do I share this?
Right at the bottom of the screen, there'll be a share screen, right next to chat. And
Yeah, but
there are three parts. Okay, there is an attendee from MeitY Startup Hub.
basic. Can you see this?
Yes, I can.
Where is the Zoom? But I can't see the video. What's happening?
Yeah, you're now on the video. I can see your cursor now. It's gone now. Yes, I can see the cursor now. You're on mute. I Sachi, you're on mute if you're saying something.
Yeah. Am I audible now?
Yes, I can hear you now.
Okay, great. So at 5, I'll start this video.
Sure. So I think someone from MeitY Startup had joined as an attendee.
So I think that would be either Rajshri or Tarun. They just wanted to check whether they're able to join or not. I think they're here.
Sure. All right.
Rajshri is here, yeah.
So when we start is when I'll actually go live on LinkedIn too, right? I don't want to go live earlier.
Yeah, sure. You can do that.
I think you can stop sharing too, right? Or you're going to begin with sharing.
I want to begin with sharing, like at 5 at least, we'll have that webinar commencing shortly until like by the time Eklavya and Jeet join. Jeet is here. You can see webinar commencing shortly only, right? Right now as well?
Yes.
Okay, great. Jeet, can you enable your video? Are you able to do that?
Yeah, hey, I'm here.
Hi, Jeet. How are you?
I'm doing all right. Thank you. Yourself?
Perfectly. Well, I thought that, although I tested it with Tarun, we just wanted to ensure that everything is working well and fine.
All right.
Let me ping Eklavya as well.
Yeah.
So that he'll be here in 2 minutes. Perfect. Hello, everyone, and welcome to our today's webinar presented to you by Recur Club and MeitY Startup Hub. Today, we'll be joined by a great panel, and we'll be going through a topic of scaling up your venture without dilution and discussing various alternatives available to founders, startups, and growing businesses. We have a great hour ahead of us, and we'll cover off on the various aspects that I think will be of the interest for the audience. To set the scene, what I like to do is give you an idea of some of the key topics we look to cover off today. So we're going to start off with the introductions of our panel and their backgrounds. And later on, we'll dive into the various alternatives available to the founders, because there's no single pathway to accessing capital. And we like to especially highlight the ones that help delay dilution. We're all familiar with the venture capital space, and but we'd like to discuss what are the options available to startups and their teams to scale up their business beyond that, especially given the current climate. So we'll explore that. And after that, we'll do a deep dive into the various criterias and processes of raising capital and the role of communication and how does it impact the entire process for companies. And finally, what we're going to do is obviously it's quite impossible to ignore the current narrative, the current commentary around the market conditions. So we'll have a concrete discussion on the outlook for markets, what the panel expects to happen in the current in the coming quarters and years, and how is it going to impact startups' ability in the Indian market and beyond that to raise capital. So without further delay, let me pass on to our panel today. We're joined by Eklavya Gupta, who is the co-founder and CEO of Recur Club, and Jeet Vijay, who is the CEO of MeitY Startup Hub. Over to you, Eklavya.
Thanks, Sanchi. Hey, hi everyone. Hope all's well. Sanchi, should we wait for a couple of minutes if you think that's right for others to join in? Let's give them a couple of minutes before if someone is joining and then start. That makes more sense. Well, I think we'll get go. Thanks, Sanchi, and hi everyone. So I think thanks for joining in. Right, like it interesting times, right? Like in which we are living. I think a lot's happening around us globally as well as in India, right? Like as compared to the macro situations, and especially in the startup world that we are witnessing, right? Like so many externalities that are affecting the way we run our business. I think it's uncanny. And the idea here is, just have a candid conversation today between all of us and discuss various options that founders today have in terms of how can they basically scale their business, b, what are the different financing options that they have, and obviously leverage MeitY's expert advice on how they are nurturing startups, its capital advisory nurturing that is required at the current stage, right, for them to effectively survive and sustainably grow. I think that's most important. So I'll start up with a 10-minute quick presentation to give you a broad idea on what are the different options that the companies have today and why are we in a situation where we are. Feel free to stop in between in terms of Q&A, and then take it from there. Just 1 second, share my screen. Yeah. Cool. So the idea is, I think baseline is that founders today are very lucky to have alternative financing options. Equity historically has been very selective, right? And with restrictive access. So there are ways to scale your company without dilution by leveraging different types of capital sources. Recur Club is basically, like a fintech platform that facilitates financing for recurring revenue companies. For all young startups that are growing, they can unlock capital based on their predictable recurring revenues. And MeitY, I think, needs no introduction, right? Like it's a Government of India's leading initiative for electronics and information technology companies, right? Which we'll talk about in a little detail. I think Jeet is the best person to talk about it. But I think they're doing a phenomenal job in the country to, nurture the talent and give them the right platform and support from the government side to get that going. So just a little bit on, why this has happened, right? Like where we are, there was excess liquidity in the markets post-COVID, right? A lot of money flew in because of central banks globally pumping in a lot of capital by reducing interest rates so that the growth doesn't suffer. What happens typically as a result of it is that the money that the central banks print typically goes for as speculative capital, right? And that is what happened even now. It went to commodities, it went to emerging market economies, it went to cryptos today, right? A lot of risky assets that give you good returns, right? Relatively on a global scale. And hence we've seen a big spike in inflation happening, right? Inflation today went up to, at a 40 years high, right? Basically, it's a problem, right? Like classic macroeconomics problem. Inflation is high, growth is not there, right? Like, so what do we do? Central banks have to now pull off liquidity from the market, right? Like, but they have to be cognizant. They delayed that process so that the growth doesn't suffer. But now instantly they had no option because the inflation levels, right? Especially if you'll see globally, are at levels like 10% plus inflation levels in the US and in the UK, right? That's absurd. Those countries are at 1 or 2% inflation levels, right? The central banks globally have raised interest rates more than 500 basis points in the last 3-4 months, which has actually led to pullback of capital, liquidity from the market, and hence all the capital that was going through, equity, commodities, etc., has stopped suddenly, and there is a dearth of liquidity capital. And these are all things of momentum, right? Like once you start pulling back capital, people get more fearful. People are more scared to invest because they don't know what the global scenario would be, and it gets into a vicious cycle, and that is where we have landed ourselves in. Typically, equity was the only option that you had. Great play, gives a good head start, but once you start generating certain revenues, you should leverage other forms of alternate capital where you can raise capital. Obviously, it doesn't come with any kinds of guarantees, no obligation to pay capital, but you lose ownership, right? Like not the best of option at the long run. So you should definitely manage your capital stack efficiently, right? Like as you grow. Traditional debt and loan, very restrictive, right? Like you don't have collaterals to pay, you don't have any mortgages to pay. So typical loan are not available to startups, right? And I think even if they are, what they take is, in terms of your part equity share, right? Like in terms of venture debt that takes part of your warrants or your, some amount of equity upside, which again is not non-diluted, right? And still limited to a very large sector of society. So what do? Companies went on taking equity, right, historically. And as a result, you can see, right, like some of the larger companies like Zomato, Policy Bazaar were less than 5% in shareholding, right? Like they kept on diluting round by round. And as a result, they have massively diluted themselves, right? And other than dilution, it's also the time and effort that they end up spending, right? Equity is easily a 9 to a 12-month process, right? Like it takes a long run process to actually raise equity capital, right? You start from preparing pitch decks to reaching out to hearing a lot of yeses and nos or maybes, right? Like then you finalize the term sheets, then there's a due diligence and a documentation process. Founders are not able to focus on what they do, right? Even in terms of debt or the venture debt options that are available, right? That comes in only if you raise equity and still takes 5-6 months, right? Like, so it's painful, right? Like, and everyone, I think all founders have faced it somewhere down the line that it's not as smooth and as easy. Equity I spoke about, right? Like comparing different financing options that are available to you. I think founders today, as I was mentioning earlier, are lucky to have different options. And that is what we at Recur Club are also, bringing in one completely innovative way in which you can finance yourselves purely based on your recurring revenues and cash flow streams, right? Equity takes a lot of time, right? Is limited to very few number of companies. Hardly 1 or 2% of startups are able to raise equity, right? What happens to the balance 98, right? Like we know a lot of them die due to lack of capital at the right point in time. Some of the ideas may be great path breaking, but unfortunately they're not able to grow. Venture debt comes with warrants, still a high cost, including cost of warrants, and only comes in when you have raised equity, right? Then there are certain options that have been introduced like revenue-based financing, right? Which values based on your revenue, but the way they charge you is a percentage of your revenue back to pay them back. And if you're a fast growing company, it's actually penalizing you for growth, right? Otherwise, it's a great idea, great model, but it's more suitable for cyclical and volatile business. And I think what we introduced is a new asset class called recurring revenue financing, where you can finance part of your customer cash flows upfront. It's like your customers that were supposed to pay in the next 12 months have paid you today, simply, right? And you precisely know what to pay, how much to pay. And you can raise up to 50% of your annual recurring revenue, that too within 3 to 4 days, right? So I think this has been truly revolutionary, the way we think, the way we act. And obviously there are tech enabled ways in which we do it, which reduces the exact cost, right? And the time in which you are able to finance, right? What does the founder need, right? Like for founders, there are two most important things: saving time and saving equity, right? That's what we focus on. I think because those are the two most important things. Founders know how to run their business, right? Absolutely. But it's the time and the equity that they want to focus on as they grow. For us, I think the new way that I was talking about, you need to have recurring predictable revenue from your existing customers. We start with as low as, recurring revenues of 75 lakh rupees INR, right? Like, so that's around 6 lakh rupees of monthly recurring revenue. If you have more than that, you are eligible for our kind of financing. Runway should be greater than 6 months, right? Like if you burn cash, if you're a cash positive company, obviously this doesn't matter. And you should have 1 year in existence as a business, right? If you have all these three things, right, you are instantly eligible. You can log into our platforms and you'll know the results within a couple of days. So I think one very important thing in general on what to focus in the current macro environment is companies should focus on some key metrics that we also look at as business, right? So I'm putting it out here, as well as, in general, it's a good business practice to focus, right? You should focus on your growth, right? Like businesses in the great segment is what I'll talk about. You should have a growth of 3x, gross margins of around 70% plus, net dollar retention, which is a great metric. You should have at least around 140% plus, then you're a great company, right? If you can focus on that. the payback period, right? Like that you get to break even in terms of the customer acquisition cost you spend should be between 6 to 12 months. And the burn multiple, which is a very important metric, which is basically, the additional revenue by the new ARR, as we call it, or the new additional revenue divided by, the capital you spent or the burn you do, right? If it's less than one, that's great. If you are burn, sorry, the other way around, right? Like, so if your burn divided by your ARR, so if it's less and you're able to generate more revenue for less burn, right? It's phenomenal. So I think focus on these 4 or 5 metrics, as you build and scale your business, and capital will follow, right? Like whether it is equity, whether it is alternate capital, it will follow, right? Like, so it's very important as founders to focus on these key metrics. Companies have used, recurring revenue financing in a lot of ways. There's an HR tech SaaS companies as a case study that you see here. They've grown 4.7x by taking Recur capital without dilution in the last 6 months. They grew from around, $75,000 ARR to around $350,000 ARR. And it's phenomenal, right? Now they have a lot of equity offers that they can bank on and grow. Similarly, you can help, reduce your dilution. There was a company, growth stage marketing tech company, which had an offer of around, $800,000 for 15% dilution when, 8-9 months back. They started with Recur, they've grown 2x since then. They started with a small limit, $150,000, which has increased to $400,000 now, right? And after 6 months, they got equity offer from the same investors, right? Which was 30% more capital, like $1.1 million roughly, and 5% low dilution, right? So effectively, it's been almost a 50% saving in equity dilution that they would have done, right? So that's the power of using and complementing these types of capital with equity, right? We strongly suggest anyone who has some predictable revenues to use this kind of capital in their capital stack. So this is a high level thing. I'll not bore you with too many things, right? Like just to give you a broad perspective of what are the different options that you have today and how can you really, leverage them to grow your business sustainably. Thanks.
Thank you so much, Eklavya. I think that was a great, insightful conversation. And I think to all the founders present with us, I think considering the current economic environment situation, things might feel or might get worse. Financing options at our disposal right now. The key goal is no longer to survive, but also to thrive. So I think, Jeet, if you could come up to the stage and probably, just say hello to our attendees right now, and also reflect upon the current funding environment and what do you think, just your thoughts on the liquidity available to founders right now.
No, thank you so much, Sashi. And thank you, Eklavya, for the quick brief intro that you gave on this financing option. And welcome to all the participants here today. And so MeitY Startup Hub is actually really focused on building the startup ecosystem. And one of the things that we really care about is bringing more capital into the ecosystem, especially in the current macroeconomic condition. So right before this meeting, I had a meeting with the SBI leadership team, because even they are coming up with the startup branch, right? Because this is the change in the paradigm that is happening, given that we are in what everyone seems to call the funding winter. There's a lot of funding that's drying up, and as it is the money used to come for the late stage growth equity startups, so they were able to raise money. But for more than 85% of these startups, the funding was always an issue, and that has become a lot more difficult, especially because everyone has started pulling back their hand and everyone is in a wait and watch mode in terms of funding. And in this time and environment, it becomes critically important for new segments of the funding value chain to be created. And the Recur Club is operating in that, providing recurrent-based financing. And that can actually really help startups now in 2 ways. One is for the startups that are not able to raise money. It's a great source to get the cash flow-based financing in terms of what's predictability of your revenue stream. Second is, given that liquidity crunch is there, the valuations are dropping. So you may not want to dilute any equity at this point and want to raise enough money to go on till the times get better, and you build more traction and generate more revenue and get a better multiple for your business. So from that perspective, even for a high growth startup right now, this is a really interesting and an innovative funding stream that we can look at. So I think this is really critically important part of the value chain that you guys are targeting. And it's really good to see the growth that you have seen over the last year since you guys launched your platform, and the support that you've been providing to the startup, because we get really good feedback in terms of the ease of getting the funding secured through you guys and the way you guys have been operating and supporting them. So thank you so much for that. And I won't take too much of the time. And I think this show belongs to Eklavya and the startups who are looking to raise money.
Thank you so much, Jeet. That was really, really warm of you to share that with us. And I think as you rightly mentioned about the funding window, right? We'd all like to hear your thoughts on how do you think, considering the current, economic times, how can startups actually, grow their businesses more strategically and sustainably? And, if you could also shed upon some light into how MeitY has been helping startups achieve sustainable growth.
Great, thank you. So I'll take the second question first.
Sure.
So in terms of a ministry, so we always look to fill in the gaps in the funding ecosystem where possible, particularly for the early stage startups, before they're ready for the market. So we have funding for idea validation, for prototype creation, for commercialization. We give up to 40 lakh rupees. We have an accelerator scheme where we are giving equity funding on the matching basis, equity, no debt, for these startups. And also we are looking at building out more funding options for the tier 2 startups, because the role of the government is to build the ecosystem, not necessarily support and promote the winners. And I think that's where the private sector comes in. And that's where we work with Recur Club and the other players in the private sector in the financing world in terms of bringing that equity or the debt or the revenue-based financing options for the startups. Now, where we are, I think today, it is critically important for us to think about the unit economics. It's not about the valuation and growth driven by valuation, but more about growth driven by value. And the customer acquisition costs that Eklavya was referring to, those kind of parameters become critically important in this time. That is it worth it for me to go out with a really massive growth plan when we don't know how we'll monetize them and when the cash flow will start coming in? So looking at unit economics in terms of the business plan, then looking at the funding options, because equity is becoming very expensive at this point. So a business is made up of three things: strategic alignment, operational enhancement, and financial structuring. So if your strategy is rightly aligned with the market, you will grow. But if your operations are not optimized and you don't have a focus on unit economics and the payback period, then you will suffer. So you have to align that. Third is you have to look at your financing mix, debt, equity.
I think there's some tiny issue with Jeet's video. Eklavya, in the meantime, I think as Jeet was talking about, I think equity has definitely become more expensive. And while you've walked us all through about what Recur Club is, what recurring revenue financing is, and how it serves as an asset class, if we could also talk about some other options that the founders have at their disposal, especially in terms of optimizing their capital structure. If you could share your thoughts on them while Jeet comes back in.
Sure, Sanchi. So I think optimizing capital structure is very, very important, right? Like for any stage of the company, right? Like it's become more important currently because of the talk of the town. But I think if you see large size companies, right, publicly listed companies, everyone optimizes for capital structure, right? Like investment banks are paid millions of dollars just to optimize capital structures, right? Like there are a lot of restructuring that we see in any stage of the company, right? So it's very important. Unfortunately, in the early to mid growth stages, people thought that equity is the only way, right, to fund themselves, because that was the only form of capital typically available. and hence, there was no knowledge, and because people were focusing on building the business, right? But I think what one should think is what type of capital to be used for what kind of expenses, right? And hence, what are the expenses that you need to make, and raise capital accordingly and build a capital stack accordingly, right? What do I mean, right? I think if you are pre-revenue, right? If you are doing some kind of R&D activities, if you are spending money on an activity where the outcome is uncertain, right? You don't know what will happen, then you should use equity, because while you don't know what the outcome will be, you don't want any obligations on you to pay you back, right? Equity is the best form of capital, hands down, right? But once you start generating some predictable revenues, right? And you need to spend on expenditures that pay you certain return, right, on your capital investment or on your customer acquisition cost, right? Like metrics like LTV to CAC, right? Like lifetime value to customer acquisition cost. People should track it very, very deeply, right? Because if you spend 5 rupees on something and you're able to generate 10 rupees plus or 15 rupees plus, right? It's a brilliant way. And if you know a particular marketing channel, distribution channel, a particular type of expenses will yield that kind of output, you should not use equity. You should complement it with other forms of capital if debt's available, or the recurring revenue financing that we've introduced, right? Don't use equity for that. Use equity as a buffer, which will enable other providers to fund you, right, based on your liquidity positions, and use that capital to grow your business, right? That is smart business capital management, right? Leverage is good, right? Over leverage is bad, under leverage is bad, right? Currently, early to mid stage companies are operating at zero leverage, right? Which is horrible. If you'll ask any investment banker, right, they'll say, hey, what is this, right? So have an optimum level of leverage which helps you to grow and scale your business, and see what are the kind of end uses that you want to use this capital for, right? Typically, I think in late stage companies, people have spoken about 50% debt to equity ratios, between 40 to 60% debt to equity ratios seems okay. But I would suggest for younger companies, I think that's a little too much. They should be a little cautious as they're growing, right? Because there is little more volatility, right, in their revenues, etc., as compared to mature companies. So I think there is no right or wrong number, but at least a 20-30% mix for debt to equity, I think that's a good number for companies to go with as they scale and build businesses. And I think what Jeet said, right, building capital stack is one thing. Focus on your operational metrics and strategy, right? Capital will follow, right? And especially at this time, and for any business, right, if you have to focus on your unit economics. So I totally concur what Jeet was saying, right? Other things will follow suit. But I think 20 to 30% debt to equity ratios or leverage in other forms complementing equity is a good number for early to mid stage companies to balance their stacks.
Sure. So, I mean, as you mentioned that, growing startups should look at different options as well to raise capital. So can you share one example wherein any growing startup has kind of successfully used by tapping into various different pools of capitals? Any example that comes to your mind?
Was that to me or to Jeet?
To you, I think.
Okay. So cool. No, I think a lot of them, right? So we work with over 300 companies currently, and out of them, around 150 companies plus have raised. In fact, 180 plus companies have raised actually equity capital in some form or shape, right? So people have started to understand, and they are complementing equity with alternate forms of capital, right? The company that I was talking about in the case study, for example, right? It's a media tech SaaS company. They have been funded, now they have been funded by marquee VC, like the $1.1 million that I mentioned about at 10%. And they used around, $150K in $1,000, like 1 crore rupees from us initially, which they increased to around 4 crore rupees over a period of time. And now they have raised around, 9 crore rupees of equity, right? Plus they had raised around, 5 crores of equity previously. So if I see their capital stack, right? So they've raised 4 crores of, alternate capital, like from us, like recurring revenue financing. And in the past, around 16 crores of equity capital. So debt to equity being around, 25%. So I think that's very optimal. And that was one of our suggestions as well, right? When we work with companies, we advise them, what is the optimum capital stack to grow? And they've used our money to spend in marketing. to spend in software implementation, where they know what is the outcome going to be. And they've used equity to start a new product line, to do some research activities, right? And to keep them in as buffer, right? Buffer money based on which we can give them more and more money. Our platform like ours can give more and more money.
Great. I think Jeet is here as well. So, Jeet, I wanted to ask you that, considering everything that's been going on in the markets around, or create a story around their idea, and how can they actually be reading or getting ready for raising their next equity funding round? And if you could share a checklist of things in terms of processes, documents, and compliance that they must keep in mind before raising their next equity funding round, or at least the kind of items that you take into consideration.
See, again, that's a very varied answer to that, right? Depending on the stage of the company,
Right.
given their big vision that they're looking at, and who are they targeting as investor? Because investors start all the way from friends, families, and fools, and move up to the angels, and then the VC funds, and then on the parallel track you have the social impact fund, you have the government as well as funding. So there are a lot of different funding agents out there, and they all have different criteria in terms of what they look for, even for the equity. So a strategic investor will look at the equity participation in a different way than a financial investor, right? They may have a certain multiple return expectation in a financial return portfolio, but for a strategic investor, they'll look at it very differently. But what I really want to harp on is the point Eklavya was mentioning about the capital structure.
Yeah.
Because I think in India, now we are in the first wave of startup funding world, and everyone has just been, even in equity, we don't differentiate between common shareholders versus preferential shareholders. There's no idea about different kind of rights and obligations that come with equity financing, be it drag along right, tag along right, clawback. So when we think that somebody is trusting us and giving us money, there's a lot of devil in the details. Because ultimately, whoever writes the check writes a rule. So you lose control every time you raise equity financing. And the more you lose early on, the less you are able to explore the full potential. And if we're looking at more developed markets of US and other places, you will see the founders hold quite a lot of equity even till the end. The reason is because they have been able to manage the funding through the different mixes early on. And especially for a company with a predictable cash flow, it becomes kind of crazy, to say the least, to go and dilute equity. But if you can get growth through your own operations and funding wise, then it's really great to have some debt in your equation, some mezzanine, some debt, and some equity. If you look at the leverage ratio of large companies, right, different sectors have different, but for example, Vedanta, or in anything you're looking in mining, materials, metal, anything capex are heavy, where there's more predictability, right? But there's high cyclicality. They have a different cap structure, debt, equity, and mezzanine, versus the software-based. But the beauty is that the cost of debt is always cheaper than cost of equity, at least in an inflationary environment right now. So if bankers gives rate, then trust me, equity is going to be much, 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 much higher. And that's where you can look at something that's the revenue-based financing, where you are getting the best of both the worlds and not diluting equity too much. So having some debt only shows prudence and smartness as a founder, because technically what happens is most of the founders are engineers and technical people. And so we focus less amount of attention on marketing and less on the finance. We only believe in raising the money, but not necessarily understanding what we are losing when we raise money. So having a really well thought out financial strategy is critically important for any company to grow sustainably and scale and not leave bad taste in the mouth as it grows, because everyone is going to negotiate at every different level to take a piece of your baby away from you. So you have to be pretty sure that you really, really want to get somebody on your cap table, but you have to make sure time is also right. So look at the different funding options that we're discussing.
Jeet, the next question is for you as well. So can you also walk us in how are you guys actually sort of enabling the founders and ensuring that the entire Indian startup sphere is actually on the rise and continues to, you know, remain on the rise by at least ensuring that all of us as founders are guarded by the right, you know, information, knowledge, funding, of course, as you said, is one of the items, but then also comes marketing, sales, your strategy, all of that. So if you could walk us through the various, you know, initiatives by MeitY.
Sure. So there's a lot of things that we do at the MeitY Startup Hub to build the ecosystem. And so we have our own funding schemes where we give grant, which I mentioned before. But more importantly, we believe that the startup ecosystem cannot be strengthened without the engagement of private sector. So we do a lot of work with various corporates because corporates are necessary for mentoring, for pilots, for strategic investment, for deployment. So we are working with Google on different program, with Meta on a different program, with Dell on different, HDFC, HSBC. Today we had a meeting with SBI Startup Bank to discuss how we can change policies and get startup funding under the CGTS scheme, where there is a credit guarantee and government is backing it up. So we are even looking at how to make it easy. So we are working on the policy reforms as well. But aside from that, what we look at is we also work with a lot of international partners. We have programs of taking Indian startups to US, Europe, France, Germany, Middle East, so Indian startups can have international market access. Third thing I think that I really want to touch on is that we are really focused on building the ecosystem in tier 2 and tier 3 now. So we are coming up with a new scheme that's going to be focused on bringing close to 500 crores of funding into the tier 2 startup ecosystem. That's what is the pipeline. Another thing that we are looking at is in the startup growth value chain, there's no funding scheme available for piloting, for doing a paid pilot of a project. So before a product is deployed, you need customer validation. For that, you need to do a pilot, and nobody's willing to pay for a pilot. So now we are coming up with we are in discussions and stakeholder consultation to come up with a scheme whereby the ministry will fund some of the pilot costs for these startups. That way they can actually validate their product in the market. So that's the gap that we are trying to fill now. But so aside from that, it's just about getting all the ecosystem together and see what relationships we can make and how do we help our startups. And if any startup has any queries or interests or anything that they want to discuss with the ministry, we are always happy for engagement.
That's wonderful, Jeet. I think we're all of us here are about leveling leveling the playing field for each and every founder, whether that be from tier 1, tier 2, tier 3 cities, right? And I think Eklavya will also have some thoughts on that. So Eklavya, just highlighting that and also connecting it with the entire review process that we have here at Recur Club, because Recur Club straddles between equity and debt. So what are the different things that you look for while evaluating a company? If you could share that with our audience, please.
Sure. So I think good thing is that there are no rights or the board seats that we take. I think that's the first part that Jeet was mentioning, right? Like in our kind of financing. So you keep control, right? Because why do founders start their companies, right? Like it is because A, they have an idea, obviously, but B, people like taking those decisions, right? Like maybe they are right or wrong, right? So the moment the control starts going away from them, right, it becomes a little, less motivated from that point of view, right? Like, so even as an investor or a person providing them capital, you want as much skin in the game as, the people running the show would have, right? It's only then when you will make money, right? As an investor. So what we look at, is predictability in terms of recurring revenue. So I think a company should have at least INR 75 lakhs of annual recurring revenue, which is around 6 lakhs, 6.5 lakhs per month, roughly. 1 year of operations, right? Like, because some amount of predictability, right? Otherwise it will be too risky. Let me be honest, right? Like it's not that any investment can happen at any point in time. If you give debt to a company that has no revenue, what are you financing them against, that is equity type of investment, right? Like, so 1 year of vintage, INR 75 lakhs of annual recurring revenue. And if you are burning cash, then have at least, 3 to 6 months of runway, right? So 3 to 6 months, because otherwise you are running yourself too thin, right? Even if we fund them, if you have 2 months of runway, you have obligations to pay us as well. You will land yourselves in more trouble, right? Like than solving for your problem. So I think as long as you have these 3 things, we can fund you up to 50% of your ARR, right? It's as simple as that. And we do it through a tech way. We integrate with your invoicing softwares, financial softwares, and banking data, and algorithmically score your companies and recurring revenue streams to give you, the financing limit and the details within a couple of days at latest. So you can get cash in bank within 3 to 4 days, as I was mentioning earlier. It's very simple. It's very straightforward. We want to keep it simple, and that's deliberate, right? Like, because founders get confused otherwise what's happening around, and the process just keeps lingering around. So we want to keep it very straightforward, very simple. And these are just the 3 things that you need, to get financing from Recur Club.
Talking about simple, I think what's not so simple, and we're all aware about that, is what's happening currently, right? And very recently, in fact, yesterday, Sequoia Capital's MD, Mr. Rajan Anand, came out to say that it will take us a long time before we get back to the 2021 funding era, right? Because if we look at the latest reports, 2021, like while 2021 saw a 2-fold increase in funding, the year 2022 up until September, there was a downgrade by 83%. So this is my question to both, Eklavya, you and Jeet, that what according to you has been the biggest shift in the investor perspective over the last 6 months? And, also, do you guys believe that this funding slowdown, or as Jeet put it, the winter, the funding winter, will it be a short-term cyclic shift, or will it last longer than, let's say, the next 2 quarters? And just highlight what will be the investment outlook according to you guys for the coming quarters and the coming years, especially highlighting the Indian market.
If you want to go first, or
Yeah, I'll take it. So see, from a government perspective, I think this is a good thing in the sense that most of the effect is on the top level of startups, right? The bottom 3/4 of the startups never really got much money coming from outside. So that's the first part. And second is this shows us that, like back in the late 90s and 2000s, we had the hot money flowing out of the stock market. Now, same thing has become even for startup. It's a hot money. Money is just flowing out so quickly. All the commitments of $500 million, $1 billion next round, they're just disappearing in a heartbeat. So money knows no religion and no boundaries, and it's the most fickle of a friend. So can't really rely on the foreign capital market as much. So for us, it's a good thing as a wake-up call that India has been resilient before in the way we have structured the economy. And this gives more impetus for us to develop the domestic rupee capital investment ecosystem in the alternate asset class. So now even the government is looking more proactively. We are working more diligently to bring more non-traditional investors into the investment space. So people who invested in land and gold and hotels and hospitals and colleges, we are trying to make them investors into this kind of funding now for startups. Second, we are seeing the traction from SBI. SBI being the leader of the financial capital market in India. If they have woken up to the need for looking at startups as a vertical, that validates the notion that startups are here to stay and the local money has to be made available for them. And third is it's giving more of innovative startups like Recur Club to fill in the gap where there is a gap in the funding ecosystem, and these startups who have the revenue but didn't know where else can they raise the money as a new approach. Otherwise, when the equity is available so easily, no one is looking at the downside of it. So now, out of the necessity, people are learning about this new approach. So I think overall for the ecosystem, this is good. But to answer your question in terms of how long we'll see it, see, this is part and parcel of life. Economic cycles happen every 10 years or 5 to 10, however you look at it. We'll see some downturns because nothing moves up in a one straight line. So we'll see some downturn now, which will again stabilize the base, make the good startups stronger, get the people who need to pivot faster and not throw good money after the bad money, start focusing on value and not valuation, and overall think about customer experience and the value creation. So all these things will come out and make our strong ecosystem much more stronger and robust and resilient. So for us, it's a positive.
That's wonderful. That's wonderful. And would you like to share some, any best practices that come to your mind, maybe from your experience, that founders of, growing startups should keep in mind considering the environment?
No, I think I briefly alluded to that before, but I'll let Eklavya talk more about it since he's more closely on the ground and dealing with the pains and hearing from different startups what they're dealing with.
Sure.
No, sure, for sure. I think what we see, right? Like, I think the biggest issue is that people get swayed away by, as Jeet was mentioning, if there is a lot of equity capital, right? Like, they will start running after capital, right? Like, let them focus on your business. I think focus on the key metrics, right? Like, and diligently track your numbers. I think it is very, very important, right? Companies who have made it big, right? All of you will see are data driven, right? Like, have that approach right from get-go, right from day zero, right? Like, don't let it be, I'm a startup, I can do whatever I want, right? Like, great, you have the flexibility, but don't overutilize it, right? So I think focus, some of the key numbers that you should definitely see is, what is your growth rate, right? Like, what is your revenue growth rates? Like, how does it compare to yourself and industry benchmark? So all the parameters you should effectively, basically take in mind that, you take into consideration. So revenue, ARR growth rate, as I've mentioned, I think what I was showing in terms of grade, I think some of the key metrics in terms of LTV to CAC, their burn multiples, keep your burns in check at this time, right? If capital in general is dying down, focus on your growth and don't spend just on anything, right? Measure the ROI. What is it that you can potentially get? What is the return on investment on any capital that you're spending, whether it is human capital, whether it is marketing initiatives, whether it is tech initiatives, whatever it is, right? Like, measure in terms of what you are giving and what you're getting back, right? I think few problems that people face, especially in early to mid stages, is forming the right team. So I think focus a lot on forming the right team, which will stay with you for long term, which align with your vision, right? People will make money in the process, right? Like, if someone is coming and joining you just for money, I think maybe not the right fit. They should align with your vision. They should align with the way you guys work, right? Like, as a team, as a, as build on that, right? Like, because it's a fun thing that you're working in an early stage startup, right? Like, leverage that culture. People leave a lot of long corporate jobs, right? Like, a lot of us have done that, including ourselves, right? To have fun. So don't let that fun go away, but be razor sharp and, work with the right set of people and have a clear strategy in mind, right? Like, I think very important in terms of differentiating roles within the team, right? On how you are bifurcating and complement each other, right? Like we say, right? Like, we complement to equity capital. I think people within teams should complement each other very well, right? Like, the CEOs or the founders are probably thinking 1 year down the line, right? Like, probably vertical leads are thinking a quarter down the line. Maybe people below them are doing day-to-day jobs, right? Like, so everyone should have their equal, well-defined role strategies, and that is how the company will succeed long run. So, which a lot of people miss. Everyone runs towards one thing and then everyone gets swayed away. I've seen it a lot of times in companies, and then they get into problem. And obviously the capital management thing that I'll not repeat that I mentioned, I think very, very important.
Okay. 100% agreed. I think it's very essential to have the right team, the right fit, and we've all experienced some or the other things that are not right in our, in our jobs and our experiences. But it takes the right amount of, or the right quality of people to actually grow stronger from there. And just to kind of continue on that, Jeet, I'd like to ask you that, you were working in the US, maybe what kind of a culture was there, and how have you seen a shift when you came back to India, and how did you come about starting and operating and growing your efforts at MeitY?
I think that's a long story behind it, but I'll tell you from my experience in US. So I was running a fund there. Plus, I was the assistant vice chancellor for investments at University of Texas System, and I had my background in private equity and late stage growth equity world. When I compare the Indian ecosystem with the US ecosystem, so back in the 90s in US, we had what's called VC culture, but it wasn't venture capital; it was vulture capitalism.
Okay.
It was more about it was back in the 80s, it was the LBO time. So leverage buyouts, put up a company, take it private, do the leverage buyout. Then came the culture of this venture investing, but it was more vulture. They were trying to capture as much of the startup as they could. That's how it evolved. And I see a lot of the similar parallels in India in the last decade here, that investors will, without understanding how they're negatively impacting the future of the company, will ask for unreasonable demands, which is neither good for the entrepreneur or the investor or the business overall, or the ecosystem, where it distorts the expectation in the ecosystem. But now in India, quite a lot has changed. Slowly we are learning. Before it was just purely common shareholding, right? Now people are starting to think about pref. People are doing convertible note now, where valuation is not possible. Now we're talking about this revenue-based financing and other mechanisms. There's a debt venture funding also starting to come into the market. So the whole funding ecosystem is evolving. What I see from the difference from the entrepreneur perspective is here, just like the investors, we are looking for quick enrichment, right? We're looking for quick successes, and that doesn't work. When you try to do this in a hurry, then you end up, replicating what was done in the US, but that won't work in the Indian market. So we need to look at the value that we are creating. Let's not run in a herd, right? Let's not have a herd mentality. Let's not all chase the same thing, because then there's no winners in that kind of a competitive environment. So the strategic big picture vision, what is the impact you're going to make? What is the outcome you're going to have? How is it going to improve the society and the world around you? Think about the purpose for creating something that you're creating, and not just making the money. Money is a byproduct for work well done. So if we are really able to execute on the vision, then India is full of opportunity, be it in health tech, agri-tech, defense tech, med tech, industrial tech, clean tech, entertainment tech, food tech, you name it, travel tech, everything. There's so much opportunity as a startup in India to scale today. We just have to make sure that we have the right market fit, we have the right capital structure, we have the right team that we are working with, the right technology that can be scaled up, and right overall stakeholder and shareholder management, so that we can take everyone's interest together and create a winning situation for everyone. And I think that's only the time when the ecosystem wins, the entrepreneur wins.
Absolutely. Absolutely. Rightly put. So Jeet, we have a question for you that it's by Krish, and he's asking us that he's asking you rather that how early stage startups requiring monetary support for prototype development can benefit from MeitY.
So we have a Type 2.0 scheme, which is being implemented through 51 different incubators across India. So you can check out on our website which incubators have those programs. You can apply to one of those incubators and be part of their cohort, and you will get up to 54 lakh in funding through that cohort for your product development and commercialization.
Great. I hope Krish, you got your answer from here, and I think we'll leave Jeet's email ID and LinkedIn link to you right after the webinar ends. So probably you can get in touch with him as well. If there are any other questions that we have, anybody would like to ask now, probably write it on the Q&A box and we can take it up. If not, then it will be a short, 1 second, sorry. So I think we don't have any other questions, but thank you so much Jeet, especially for joining us at this time, and Eklavya, to the both of you and to the attendees who took our time to attend the session today. We'll be sharing the video link with all of you guys as well, so that you can always go back and look at the tips that both Eklavya and Jeet shared with you. We'll be sharing that with all of you shortly. But thank you so much, everyone. It was a wonderful session, wonderful speaking with you, Jeet, especially, and Eklavya. All of you have a great evening, and bye-bye.
All right. Thank you.
Thanks everyone. Have a good day. Bye. Thanks, Jeet. Bye.